Okay, welcome back. Let's continue the question. Can I explain the 10,000 again? So how was this calculated, right? So this is like you sum up prepaid insurance, right? You have prepaid insurance here, right? It's debit. And you have prepaid insurance here. This is debit and this is credit. And you have to net it off. Then 40,000 minus 30,000, you get 10,000 here. And this yellow section is a combined entry. It's combined all the journal entries all together. Then you got this one. Did I solve your problem, Jennifer? Okay, let's move to the next part. So just one more sentence. Like when you do the journal entries in exam, and you can write this part and you can write the combined one. Both are fine. Right. So this 10,000, let me explain again. For the total 40,000 expenses, we used to booked 30,000 actually already happened. It's happened, so it will be booked into expenses. There are 10,000 is still remaining in the prepaid expense. That's what it means. Okay, I'm gonna mute you. All right. Let's keep going. At the end of the year, staff reported 2,000 of supplies inventory on the balance sheet. However, a detailed count by the auditors produced only 1,100 of supplies. What was the error? Actually, there's no error here. So the other missing 900 could be put into use and is not booked and is not recorded yet. So we just have to make an adjusting entry. So here, no error. We just need adjusting entry. Yeah, writing just the one in yellow is fine. Okay. So in order to have the adjusting entry, we debit supplies expense.
Like sometimes I play like some video games at home.
Yeah, I used to play a lot of games, but I don't really feel like
You guys wanna mute yourself? Supplies expense. And how we calculate is just to use the 2,000, subtract the 1,100, right? I won't write it here. And credit. Supplies inventory. And you put that. That's it. The question C, the company recorded a collection of 20,000 from its suppliers. by debiting cash and crediting accounts payable. What was the error? So the company recorded a collection from its suppliers. So actually, they're talking about account receivable. So this company shouldn't use the account payable. That's the error. So they shouldn't. Shouldn't use debit cash. They should, right? They should. We can just talk about what they should do. They should use debit cash and receivable. But my audio isn't really good. Do I have to speak louder? I don't know what I can do. Anyway, okay, yeah, no problem. Okay, so we should use the debit cash and credit account receivable, right? Because we are collecting money from our suppliers. Okay, and what we should do, first of all, we should do the reversed entry, right? And in this way, we reverse it to the original point. And then we do debit cash. Credit accounts receivable. So be aware this is AR and this is AP. 100,000. So and that's it. There's no year-end adjusting entry. And of course, at the same time, you can combine these two together because here is the credit cash, right? Here is debit cash, and it's the same amount. So these two offset, and you can just put debit payable. So credit accounts receivable. So this yellow section, this two line is a combined entry. So in the exam, you can write the first part or you can write the combined one. It's up to you, as long as you got it right. Okay, let's move to the next one. revenue recognition. So in IFRS 15, we have a revenue recognition criteria. There's the 5-step. I hope that you still remember this. So the first one is to identify the contract with the client or customers. For example, you have to know who is the seller, who is the buyer, and get to know the terms. It must be include some information about pricing, about what kind of contract it is, what kind of obligations you have, right? And secondly, you have to identify the performance obligations in the contract. So this could be a bit tricky because there's the, for example, some of the service are, like bundled up together. Like when you sell a car, at the same time, you sell the insurance to the customer. Then it's two perform obligations. One is to deliver the car, another is to provide the insurance service. So you have to identify the performance obligations. And then the third point is to determine the transaction price. As the example I just cited, like if two services are bound together, then you have to determine what is the transaction price. And then the fourth item is allocate the transaction price to the performance obligations in the contract. So a car price is for the car, and the insurance price is for the insurance. So you have to allocate this properly. So sometimes they mix this together, but you have to find a way, probably by like the amount that you deliver. Like you deliver several items B, and you deliver like several items of A, and then you can allocate the price by comparing the values or the amounts or the units of these two different items, just to make a calculation and do a like mathematics, calculating the portion, right? And the fifth is to recognize revenue when the company satisfies the performance obligations. So this is always done when the product is delivered or service is provided. Okay, this is quite simple. I won't spend too much time talking about this. So let's have a look at the question 5. So this company produced industrial lawnmowers for arenas and stadiums in the Lower Mainland. On July 1st, 2022, they struck a deal with Stadium X to manufacture 4 industrial lawnmowers for a total price that will be within the range of 1 million to 1.4 million, depending on the market rate on the time of delivery. And the Stadium X paid a deposit of 200,000. When you see deposit, please note it down. It's always like deferred revenue, because you haven't provided the service yet, but they paid you money already. You get the cash, so it's deferred revenue. It cannot be recognized as revenue yet. And on July 1st, we'll pay the remainder upon completion of the contract. Total cost to manufacture all 4 machines are 500,000. On December 31, 2 lawnmowers were finished and delivered to Stadium X. So we are required to prepare the 2 journal entries on December 31, 2022. Okay, so let's get started doing this. So first of all, when we accept the deposit, we would have debit cash, right? So we have 20,000, 200,000. And at the same time, we create deferred revenue. Another same amount, 200,000, and make this journal entry here. And at December 31, we have finished and delivered we put the date here, December 31, right? So on December 31, we have finished and delivered 2 of the machines out of 4. And therefore, we are 50% complete and can recognize the revenue and cost for 50% of the machine. So we get this 50% done. And this is the information that we have. So we know that we have deferred revenue, right? So we have the deferred revenue already. And by at the end of December, first of all, we can recognize the sales revenue, right? We put it here, just to put the sales revenue here. So this is the tricky one, right? You can always start with the some of the accounts that you are familiar with, and then you gradually do the rest, right? Because we can recognize the revenue already, so we will credit sales revenue. Why is this number? Because 50% down, and we were accountant, and we are trying to be prudent. We don't want to overstate the price, so we just use the the lower one, like this one. And 50% down, you use this to times 50%, right? And then you got this number. So this is the revenue that you can recognize. But we know that a part is already booked in deferred revenue. So we put deferred revenue here. Right? How much we have? We have this amount. That's the one that we previously booked. And the other part, it should goes into account receivable because the Stadium X haven't paid us yet, right? We just delivered our product, and we are expecting that they will pay us in the future. Right? This is account receivable. And then you just do the math, what is left? 300,000. And when you do the revenue, what is the rule? You always credit revenue. So we credit revenue. And account receivable, when you have more accounts receivable, is assets. So you always debit assets. You always debit accounts receivable when it goes up. And because you used to create deferred revenue, right? Used to create deferred revenue, and right, and now this revenue has to be transferred into, revenue, the real revenue from assets to revenue. So you have to debit. Oh, sorry, my bad. Let me read this again. Okay, because you used to credit deferred revenue and you have to transfer this part into sales revenue, so you debit here. So in this way, the amount of the total debit will equals to the credit. Yeah, that's it. And this is the deposit. Okay. Why accounts receivable goes up? Because they haven't paid you yet. This is the deferred revenue. You know, deferred revenue is a liability, right? So previously your liability goes up because they paid you, but you haven't fulfilled your obligations. But right now you have to make your deferred revenue goes down. So you debit the deferred revenue to show that you have already fulfilled your obligations because we have delivered 2 out of 4. And account receivable is kind of asset account. It goes up when you debit it. So we assume that this company only paid a deposit of 200,000, but the else is not paid to us yet. So we assume that we will have more account receivable towards this company. So the account receivable goes up. Why do we credit deferred revenue as well with cash? Because I just explained previously, when they paid us the deposit, actually we are not providing any of the service yet, right? So deferred revenue is liability. So we own our client something, but we have the money, the cash already. So the liability goes up and the cash is a kind of assets, it goes up as well. And when we fulfilled our obligations, right? So this amount can be transferred from deferred revenue to the revenue because we don't have that much liability anymore. So we have to debit deferred revenue. This is like to debit the liability to let it goes down, right? And then actually this amount is transferred into revenue. That's how we do this. And account receivable goes up is because we assume that this company, the Studio Max, has not paid us yet. So we are expecting to collect this amount of money in the future. And this amount is already paid. This is the deposit. Do I solve your problem? Okay. Next one. So when you see this sales discount, it means that if you pay within 10 days, you will have 2% as the discount, and the balance is due in 30 days. Okay, and the journal entry we do when item is sold is we debit accounts receivable and credit sales revenue. And at the same time, we also have to recognize the COGS, which is the cost, right? So we debit cost of goods sold.
I honestly like the Burnaby campus one as well.
Before you were a Burnaby hater.
I'm gonna mute you.
But now it's like I don't like being.
Who is
Oh, I
talking?
hate it so
I
much.
don't like both areas, like as in like that's not like a mountain. You have to go so
Yeah.
far.
Felix, I'm gonna mute you. Okay. So so when you sell something, when you make the journal entry for revenues, please make sure that you also make the journal entry for cost of goods sold relating to cost, right? So you cannot miss the second part. So you have to debit cost of goods sold because it's a kind of expense to show that your expense goes up. And at the same time, you credit inventory to show that your inventory goes down. It's like your assets goes down, right? Because you use the inventory. The item that you sold, you use the inventory. So next part, we will talk about internal controls and cash. So the bank reconciliations ties the cash amount in the company's book to the cash amount in the bank. So we have to make sure that there's the reconciliation between the company's book and also from the side of the bank, right? So why do we have to perform a bank reconciliation? First of all, it will help to identify the difference between these two sides, two perspectives, and this help us to identify the bookkeeping errors. And at the same time, it could seek and find out the difference and resolve and explain the discrepancies. And the third one is it will help to contribute to the company's internal control. So in this way, you know that your journal entries are properly booked. You know that your trial balance will be working, and you know that your balance sheet will reflect the real ending balance of all the accounts. Okay, so how can we perform a bank reconciliation? We have to perform both bank to books and books to bank reconciliation. And both of these must end up with the same adjusted cash balance. So we can start talking about the bank to books. So when you see banks in the very beginning in the front, it means you are standing from the perspective of banks. So you have to start with the bank's cash balance, right? So make sure that this is some adjusting items that you have to pay attention. So for example, when there is some deposit in transit, it could be, other people make a deposit on weekend, but at this time the bank is closed. So the bank cannot do anything, but on the, the company side, they probably already booked this. So there will be a difference between the company side and also the bank side. So from the bank's perspective, you have to add this part back, right? You have to add in the deposit in transit. And similarly, like if a company write a check and gives this to the other party, and this party hasn't bring the check in to the banks yet, so it's like outstanding checks. The company has already paid, but it was not booked by the banks. So the banks has to subtract this amount, right? Make some adjustment. And of course, if you have some bank errors, you have to make some adjustment. And let's have a look at the company side, right? So you have to start with the company's cash balance. And also the second step is to have some adjustment for transactions that affect the cash that have not yet been recorded in company's book. So that in the end, you will have the adjusted cash balance. So what you have to add on is the interest earned in the bank account. So sometimes bank give you insurance or interest automatically, but it takes you some time as the company to find out. It takes 1 or 2 hours or maybe 1 or 2 days to book, because you need to check the bank balance and you need to get the bank slip from the bank, right? And also what else do you have to add on is the bank collections, like the customers who pay directly to the bank, so you haven't booked this yet. And then you have to add this on as well. So what you have to subtract is some bank charge that is not recorded in books. For example, service fees or like printed check cost. And the bank could charge you automatically, but you don't know this yet. You have to book this. So for you, you have to make some adjustment. And another thing I want to talk about is the NSF checks. It's called not sufficient fund check, right? It's also have the name of bounced check. It's like when your buyer or your customer pay you, they give you a check, but later you found they don't have enough money on their bank account, or they have already, gone bankrupt, but you don't know it yet. So this check is invalid, right? So the NSF is short for not sufficient funds. Let's read this, sorry. So the NSF is short for not sufficient funds and refers to bounced check. When the company receives the check, it assumes that the customer has paid and increased its cash balance. When it discovers that the customer's check has bounced, the company must reduce the cash balance and re-increase its AR balance. Therefore, to reconcile the cash on the company's book with that of the bank's statement, we must reduce the company's book for the amount of the NSF check. This is, too complicated. Just when you have the, other people pay you NSF checks, you just subtract this, right? And also ETF payments. What is ETF? Is electronic funds transfer, right? So when you receive the by bank on your behalf via ETF, you have to add this down. And when you have ETF payments, you have to subtract this, right? This is some of the cash payment via ETF. Okay. So let's have a look at the example. Brad Pitt sells an industrial oven to the Piper for 2,000. Right, so what will you do? You will debit account receivable. Right, this is from Brad Pitt's view, right? So you have a account receivable and you make a revenue, you create a sales revenue, and this is the first part. And then this company pays the Brad Pitt by check, and then you assume that you have already collect the money, so you debit cash, and at the same time you create account receivable, right? But if this check bounces, Brad Pitt's cash balance is overstated by 2,000, right? They did not receive the payment they sought. To reconcile this, it must decrease its cash balance by 2,000 to match that of the bank's statement. Okay, this is quite straightforward. Let's move to the next part, accounts receivable. So we will talk about accounts receivable. And before we talk about accounts receivable, we have to say, if we want to be accountant and do an accounting job, we have to be very prudent. We have to be careful, and we should, try to make the accurate projecting about the uncollectible part of the account receivable. It's not like all the account receivable we can collect back, right? So first of all, when we estimate some part of the account receivable is uncollectible. We debit credit loss. This is like expense. And at the same time, we credit allowance for expected credit losses. So it's one of the AFDA account, which is allowance for doubtful account. But at the same time, you can just write this name. It's similar. And when this account receivable really become bad, when it does go bad, we have to write them off. So what we do, we debit allowance for expected credit losses, and we credit account receivable. Because the account receivable is a kind of assets, right? you credit assets to show that your assets goes down. And here, because credit losses is a kind of expense, you debit expense to show it goes up. And when you do the journal entry, you always start with something that you are familiar with. So I recommend you in the exam, you start with this first and this is first, right? And then you do the FDA account. Okay. So what if the client repays the bad debt? Then you have to reverse it, right? Because previously we debit AFDA and credit AR. And this time we debit account receivable to show that your account receivable goes up. And then you do the reverse one, you credit AFDA. And at the same time, they pay you back, you got a cash, right? So you debit cash and credit account receivable. And of course, you can combine this together, but I recommend you to write step by step. Okay. So let's move to the next part. When we calculating there are two ways that we're trying to estimate the uncollectible amount. Like one way is to use the credit sale method, which is you start with the beginning of AFECL, the beginning balance of AFDA, and then you credit then you add credit losses for the year. So nice. Right? And then if you have read off because it has already been erased, so you have to subtract the write-offs. Subtract the write-offs here. And you have to add on the recoveries. If you have any of the recoveries, you have to add it back. And then you get the ending AFDA or the ending AFECL. And this is one method. It's called credit sale method. And another way that you can do this is to use the aging method. You start with the beginning balance of account receivable, and then you add credit sales. Right, it's the new added account receivable. Right, it's the what you sell on credit, and then you have to subtract cash collections. It's the amount of the cash that you already collected, right? And then you have to remove the write-offs as well. And then you do add back the recoveries.